Well, the one thing that we hear in the market often, and it's often true as well for investments, is that higher the risk, higher the return.
I think it's not just restricted to investments. In life also, we sometimes take more risk and sometimes take lesser risk depending on what my risk appetite is.
That's true, actually. So there are some people who actually have a higher risk appetite. There are some people who are conservative. And then there are the ones who try to strike a balance. And just like that, in mutual funds as well, there is a category which strives to strike a balance between equity and debt. These were earlier called balanced funds, and now they're called the hybrid funds. So they can invest in both stocks as well as bonds, and that's how they get their name as well.
Depending on the extent of equity and debt, they're also further classified as aggressive hybrid funds and the conservative hybrid funds. The aggressive, as the name suggests, have more of equity proportion vis-a-vis the conservative ones.
So whether it's aggressive or conservative, how does the fund manager actually move money between equity and debt? Is there a set formula?
In each of these classifications, the style of investing could be dramatically different. Some funds keep the allocation between these two asset classes absolutely static, whereas some dynamically manage it mechanically as per the valuations of equity relative to debt.
A lot of the people actually invest in funds basis the fund manager. But in this, given that the fund is investing in both equity and debt, how would you select your fund manager? Would the same person be managing both the equity and debt portion?
That's a very pertinent question, Sumaira, because the skill set needed in a fund manager to manage equity is going to be different than in debt. So most hybrid funds actually have two separate fund managers taking care of the responsibility for that portion which they are skilled to manage.
Okay, so how is the taxation then defined? Because I can imagine that a static fund which has a fixed portion to equity, which is the dominant portion, would be taxed as an equity fund. How are the others defined?
That's another important question. The aggressive hybrid, which generally possess more than 65% in equity, are classified as equity funds from a taxation standpoint, and the conservative ones, as the name suggests, have a lesser portion in equity, so they're categorized as debt funds from a taxation standpoint.
You know, Feroze, they sound very good actually, and for a period of time they were very, very popular, these balanced, or now they're called the hybrid funds. Why are they now losing their edge?
I think there are several reasons for that. To name a few, the cost is higher because you're paying more cost on the debt side as well, point one. Point two, the dividends used to be tax-free, especially for the aggressive hybrid category, till April 1st, 2018. Now they are taxable at source. That's the second reason. The third important reason is data clearly shows that if you've combined a separate equity fund and a separate debt fund from the same asset management company, the output is significantly better.
So is there a category of investors that these hybrid funds are still recommended for?
This category especially is relevant to retail investor who only has 1,000 rupees to invest. He or she can buy one hybrid fund and get the best of both worlds rather than separating the 1,000 rupees across two different funds. The second reason why they are relevant is because investing is all about the mind and the heart both. Because the NAV comprises debt portion, the volatility in the NAV is lower, so it is meant for the weaker hearts for sure, and the beginners as well.
That's true actually, Feroze, because you know it's not a small category. I mean, the aggressive hybrid funds actually have what, 1.5 lakh crore rupees at the moment in AUM. The conservative hybrid funds have about 15,000 crore rupees. So it's by no means a category which can be ignored yet.
Yes, surely. With that kind of size, you can't ignore a category. And if you already have some money in the 1.5 lakh crore which Sumaira just mentioned, consider moving from dividend options to growth option to make sure the tax efficiency of those balanced funds, which are now called hybrid fund, is retained.
Isn't it true that now when investors think about mutual funds, they only think of the long term? But what a lot of people seem to forget is that the largest category within mutual funds is the liquid fund category. So these are kind of debt funds which actually invest only in very short-term securities, and therefore investing and redemption becomes very, very quick, easy and fast.